This is an under-owned sector hugely, and now these companies are printing money with gold trading $3,400 an ounce. Silver's testing 40 again today. So when you get a small percentage, even if you get 2.5% of money moved into precious metals, that's massive compared to the market cap of precious metals. So it could be big.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 21st through July 28th, 2025, while supplies last. First this week, we have a special on pre-1933 gold. MS62 $20 Liberty coins or MS63 $20 St. Gaudens coins
are just $90 over melt. Own a piece of American history at just $90 over melt.
Next, backdated 1-ounce Platinum Eagles are only $270 over spot. And finally, Dealer's Choice 90% Constitutional U.S. Mint Silver Dimes and Quarters are just 65 cents over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Greg Weldon from the Global Macro Strategy Report. Greg, thank you so much for joining us today.
My pleasure, Elijah.
Well, it's great to have you today. I did want to discuss what the Fed is doing and kind of the language that Powell has been using recently. You've mentioned how currently we're seeing a credit contraction. Can you expand on this?
Yeah, absolutely. I mean, the consumer is really starting to choke, and it's not just that inflation, probably bottom and starting to rise again, and that to be a function of what the Fed's going to do next. But it's kind of just a cumulative dynamic since the pandemic, where you printed all this money at $6 trillion plus in savings, you spent it, all right? Then you started borrowing on credit cards like crazy at the highest interest rate in history to do so. And you have had record borrowing up until July of last year, really June of last year. Since then, you have seen delinquency rates hit levels that precipitated the 2008 financial crisis in many ways. So delinquency rates, not only on credit cards, but now also auto loans, something we didn't see in 2008, are making the highest levels, that we've seen in literally decades, if not ever, on something like an auto loan. So, the delinquency rates are high. The consumers kind of tapped out in terms of the willingness to continue to borrow money from those sources to, maintain consumption. And now all of a sudden, too, what you saw with the first month's budget numbers from the Fed in January, first month of the year, not the fiscal year, for June, for June showed a month-to-month decline in debt. I mean, we haven't seen that except once in the last decade, and that was in March of 2015. So what does that mean? Well, that means if you look at the PCE data, transfer payments fell. That's a big part of disposable income. Transfer payments fell by over $100 billion. What are transfer payments? Government handouts and entitlements. So if you're reducing the government budget, you're reducing spending by the government, including to the support for the consumers. So you've drawn down savings, you've maxed out your cards, delinquency rates are through the roof, your housing market, if you want to sell your house, you're kind of locked in because of mortgage rates. This is a real conundrum for the consumer, to the point now where you're finally seeing, and you're seeing retail sales on a real basis on discretionary items decline for a while, about 18 to 24 months. But now on a nominal basis, you're seeing declines, and especially on a rolling 12-month basis. That's the best way to look at it in terms of forward growth in the economy. What we've seen is a pancake flattening to basically zero. And that's a problem. When you look at something like spending at eating and drinking establishments, that's the pinnacle of discretionary spending. If you feel good about your income and everything, you're going to go out and celebrate and have a couple drinks and have dinner, whatever. If you don't feel good, you're going to stop at a fast food place on the way home, and feed a family of four for the least price you can. That's where you're at. You have no savings, to the degree that now the PCE numbers showed a $50 billion decline in spending and a $50 billion decline in proprietors' income, which offset all the gains in income. And then you go to the labor market, where you see the biggest change. They said the employment dynamic, the employment report for June released 2 weeks ago, was strong. That was across the board. Every media outlet talked strong. Every pundit talked strong. The government talked strong. It was nothing but strong. I mean, it's everything but strong. It was not at all strong. And it had hints of deflation. And when you're talking about the biggest monthly change of any statistic in that report was the 329,000 increase in the number of people not in the labor force. And when you see the difference between the number unemployed and the number employed, you see that 233 people that were unemployed, 233,000 that were unemployed, for longer than 12 months, decided to drop out. They stopped looking. They couldn't find a job. And that is why the unemployment rate fell, because 329,000 people dropped out of the equation, not because 74,000 new private jobs were created, and there was only 2 sectors that created those jobs, social services and healthcare, and leisure and hospitality, which is the second lowest paying sector of all. So what do you have? You have 8 out of 19 industries posted job growth. You had 14 out of 19 industries report hours worked were lower. You have average weekly earnings. I don't care what average hourly earnings do. It's about weekly earnings, hours worked, because that's what you take home. Weekly earnings deflated. The year-over-year rate of change now is barely positive relative to inflation. And you saw personal spending decline. You saw savings decline. You saw income decline. You're into this consumer cocoon is what I call it. And that's the now feeding into a credit contraction, which is indicative that consumer is tapped. The consumer is choking. That's the driving force for the economy. And the Fed is not paying attention. They continue with a narrative that feeds into the narrative on the pop media, which is the consumer is strong. Because all of a sudden, I suggest the labor market had hints of deflation and is clearly weakening. And some of the left wing now, the right wing political, it's like not all the same. All of a sudden, some of the conservatives are attacking me because by saying the labor market's weak, I am rooting against Donald Trump somehow. And that's just like mind-blowing, man. When you get this level of no matter what side, you always thought the conservative side was a little better than the liberal side, certainly not as extreme in most cases. But it's sad to see that a little power and all of a sudden it's like you want to misdirect and misinform the public about the real true narrative, which is the consumer's hurting, the Fed's doing nothing, real rates are restrictive. And Fed hasn't moved yet, and that's causing, it's going to cause a problem.
And you mentioned how the Fed isn't doing anything and that they really aren't recognizing this credit contraction that's happening. What do you think the Fed has to do? I mean, there's this idea that Powell is kind of a second Volcker in some sense. I guess, what does this credit contraction mean for people going forward, and how do you think the Fed is going to be reacting to this?
That's a good question, and there's 2 different answers to that. First, to deal with Powell, he's a disciple of Volcker, so yeah, it's kind of the newfangled Volcker. And I did a piece 2 years ago where I compared Paul Volcker's first Humphrey Hawkins testimony on Capitol Hill, 1978, took the speech, took words out of it, and compared it to Powell's last year's Powell's thing at the Jackson Hole Symposium, right? And the words were like the same. I mean, virtually. The biggest difference between Powell and Volcker's commentary over a period of 2 years each was that Powell said a couple of times that maybe a credit contraction wouldn't be the worst thing, all right? Volcker was very careful to say we can't let a credit contraction happen. And they had no credit, they had no debt back then. See, that's the difference. In 79, 80, 81, when they defeated inflation, they had no debt. Reagan came in and could spend the hell out, beat the Russians by outspending them on defense and the whole 9 yards. That sparked a 40-year binge was come to an end. Because, when you have more debt than GDP, when you have household debt of 18 trillion, public debt of 36 trillion, it affects the whole dynamic around Powell and his legacy. Because if he's a Volcker disciple, he wouldn't let a credit contraction take place. And it's clearly unfolding now. It's not in the bank lending to, overall credit outside of consumers yet. And that's a good thing, because if that happens, that would really, exacerbate the weakness that's about to kind of play out. So that's number one. And it affects the consumer. I mean, in some ways, if it forces the Fed to do something, which I think it ultimately will, the question becomes, what's it going to take to force the Fed to do that? And what Waller said, who spoke last Thursday, he said a couple of things. And what was interesting is I've been saying the Fed is falling behind the curve here. They're behind the monetary curve, all right? They, for the third time during Powell's tenure at the Fed, the whole thing around that inflation was transitory, all right, and the whole thing around getting inflation even higher at some point, which was their goal. I mean, they've done what they wanted to do, but they have missed the turn every step of the way, and they're missing the turn again here. So the question becomes, what has to happen? And I mean, I don't even know, because what Waller said is what I believe. They're behind the curve, and he said if we wait till September, it'll be too late. We'd be behind the curve. And his whole thing, and I just wrote a special, be happy to send to anyone who's listening here today, because the thing we haven't mentioned that we will be next, which is global debt, besides the U.S. debt, all right? But if you talk about the U.S., Waller was, look, we should be neutral now, all right? Because we're restrictive, and the economy needs it. The labor market, don't be fooled, the labor market is weakening. So he's very plain about that. It sounded like me. I actually wrote it, in kind of tongue-in-cheek, like I didn't realize, Fed Governor Waller reads the GMSR, my product. So because he was like saying what I've been saying for, weeks, if not months. And also saying, and here's the thing too, just to interject, getting to neutral now is important because inflation is going to rise, and it's going to handcuff the Fed in terms of their rationale to be cutting rates, all right? And when inflation rises, they're going to want to be stimulative, which they would be if inflation is rising and they already cut rates. That's being ahead of the curve and kind of preparing for what's next. They're not doing that, and Powell has never done that, so there's no reason to expect them to do that. So unfortunately, that means the worst case for the consumer, because they're going to wait till employment dynamic gets worse. That's what they're waiting for. And it's already bad enough in a lot of people's opinions, including Governor Waller. And there was a lot of interesting things that he had to say in his speech about what the Fed should be doing. And he did say that, the thought process here was that they might have had the votes in June. It was very close. So, I don't know. I wouldn't say July is off the table, but I would say that the data was strong enough in the top level. If you even stuck a spoon into the dirt and got underneath the surface, let alone a machine, or what do you call them, a backhoe or whatever, to dig out the data points that were important, you would have seen that there's weakening in the labor market. So, but at the same time, this is Powell's narrative. He's playing it safe. He continues to think tariffs will spark inflation, which they will. But at the same time, that inflation will be borne by the U.S. consumer, which will put them even deeper. It will be the kind of the death blow for the consumer. And Powell seems to be willing to allow that to happen.
It does seem like, if we do see higher inflation, as you mentioned, then yeah, the Fed is trapped, and it's the worst thing for the consumer to have higher rates at the same time as high inflation. So it seems like.
And think about this. Here's another one, just to throw this before you get to the next question. I mean, think about that. And the most debt like ever on consumers, over $5 trillion in total, $18 trillion on a household basis. And when you look at credit card debt, it is now higher than savings. The only other time we saw that was in the lead up to 2008, 2009. The writing is on the wall. The other one is personal consumption expenditures versus personal income. Until this most recent month, when it flip-flopped violently, you had people spending so much more than they were earning month to month. So when that flips, man, that's a problem. And when you don't have growth, I don't mean it's okay to stay where you're at, okay? GDP, 28 trillion. Well, it was 28 trillion last year. That's pretty good, 28 trillion, right? No, you need growth to service the debt, because the debt cost is growing, the debt is increasing, and that applies to the consumer just as well. So it's a problem going forward.
And the stock market continues to be at all-time highs here. So you're mentioning how this really reminds you a lot of 2008. Does the stock market action as well remind you of that period as well?
Similar but different. I think that the dynamic is that the dollar is what's lifting the stock market now, in my mind. You have now a dollar that is about 12% off its high from 2022. It's up a little bit just in the past few days, but the longer term secular trend has broken in the dollar. And this goes all the way back to Volcker. Everything kind of ties back to this 40-year downtrend from 1981 in interest rates and inflation and the dollar, all part of that. All right, what you had in 1981 was a very strong dollar, because U.S. interest rates, you get a 20% CD at the bank, for crying out loud. That's a reality. 20% at the bank for a couple of months. So in that context, big flow of money into dollars, to the point where in '85 they had to execute the Plaza Accord, where they divided the dollar. G7 got together, said the dollar's too strong, it's choking global growth. And all of this kind of precipitated the fact that we had no debt then too, precipitated what you saw for the next 40 years. So in that context, when you start to talk about the stock market, you've had mostly a dollar decline into 2008, and then you had a rise, and then you had another decline into 2011. The dollar bottomed then because all of a sudden now the economy is recovering from all this, right? So and interest rates in the U.S. are higher than other places, right? Our growth is higher, our interest rates are higher. That brings money into the dollar. So you have this gigantic downtrend in the dollar from 1981 to 2011. It's a double bottom, 2008 and 11. Then you go on an ABC, perfect 50% retracement of that entire 26-year decline into the 2022 high. It's an ABC, 50% is perfect. You got the trend line that matches, the 15-year trend line now matches off against the 5-year moving average. You violated it earlier this year. You violated the previous low earlier this year. The rate of change is now about 6% negative, which is pretty healthy. So that is the most bullish thing for stocks. The tightest correlation between any two markets in anywhere in the world really is a lower currency is a higher stock market and vice versa. And now evidence the fact though, that applies to places like Argentina, to places like Nigeria, Pakistan, Turkey, all these places, Venezuela, when they still had markets, where you had a depreciating currency that was driving the stock market up, but it wasn't keeping pace with the debasement of the purchasing power of the currency. That's the problem. So yeah, stock market could go up here in a big way, especially when the Fed starts to ease. But as inflation increases, it'll be increasingly hard to keep up with the pace of the debasement of how much stuff your money can buy just by being passively invested in stocks. So it's kind of like, almost like fool's gold at this point in terms of stocks. And then it's like, where's the leadership going to come from? AI, I think, has a long way to go before it's selling products to the consumer. Isn't it about profits and all this kind of thing? So I think AI has, certainly upside potential, but not necessarily in this next phase. When if the economy turns down, it's not going to come from the consumer. It's not going to come from China, where it used to be, where their imports of our goods and, we were getting cheap goods from them, blew up their exports and provided them income too, which was then spent. So you have a lot of places, even green, clean energy now is not going to be a driving force. So where's the leadership going to come from in the stock market? I think commodities. And I think you could see a thing where, people ask, do we have the Mag 7 and stuff? And, I live in Palm Beach, and there's a lot of people a lot more wealthy and successful in their industries than I am necessarily, that actually ask me in the gym, stop me, what do you think? Like they're uneasy, they're uncomfortable. They know that this thing with printing money runs out of steam somewhere, and they need to take what I call financial prophylactics out of the drawer and start to think about using it. Because the dynamic is, real returns will be much lower in this environment. And instead of asking, do we own Mag 7 stocks, people might start to ask, do we own Mag Silver? Do we own Freeport McMoran? Do we own Newmont Gold? I mean, this is an under-owned sector hugely. And now these companies are printing money, with gold trading $3,400 an ounce. Silver's testing 40 again today. Platinum and palladium broke out. I think I even mentioned that the last time I was on with you. I mean, platinum and palladium were so ridiculously undervalued. It was one of the easiest trades in a long time to be buying platinum and palladium just recently, and it's exploded. I throw uranium into the mix too. When you talk about long-term energy and some of the other commodities where you see rotation of Wall Street money, which would be huge because you don't have any other leadership. People will want protection, and you're going to see some big movement of money. And the mining shares, they're not as deep as, as tech is in terms of the volume and liquidity. So when you get a small percentage, even if you get 2.5% of money moved into precious metals, that's massive compared to the, market cap of precious metals. So it could be big.
In your take, as we're seeing today, gold and silver rise, obviously, as you mentioned, silver hitting $39, gold again at $3,400, platinum rising as well. Your take on just these daily motion movements we've seen recently?
Yeah, it gets back to everything we're talking about. And the one thing we haven't talked about, which is the new Institute of International Finance, who keeps the global debt data, kind of officially. New numbers, $324 trillion in global debt between corporate, household and government debt. And you're talking about 324 trillion. That's 324 plus 12 zeros. All right. I think that we've come lulled to sleep with the size of these numbers, where it's like, okay, hey, that's the problem with it. Just print another trillion. It's kind of what we did when the SVB Bank went belly up back in whatever it was, 2022. they immediately printed like, hundreds of billions of dollars in like a week or two. So it's kind of like we don't understand the full extent to which this is a problem when it's global, when 61 countries spend more than 10% of their revenue on interest payments. It's not just the US, this is global, this is Africa, this is Asia. The biggest growth is in Africa, Asia, Oceania. And then you talk about, Europe's going to spend more money now, France, Germany, all of a sudden on defense. That's been a big contributor in the first quarter. Huge first quarter, 10% annual rate in global debt growth at levels that are just almost unimaginable, mathematically. So when you talk about that, all of a sudden now, what are you seeing? Two markets that look exactly the same in every single country right now that is essentially a developed nation. That is steepening yield curves and 30-year, 10-year bond yields that are breaking out to the upside. US 30-year pushing 5%. It's the same in the UK. It's the same in Germany. It's the same in New Zealand, in Canada, in Australia, in Denmark, in Belgium, in the Netherlands. It's everywhere. Curve steepening, long bond yields about to break out. What I call the launching pad, where it's a flat top and you got to have the gentry holding things in place and you're waiting for the countdown to start. That's the biggest thing. That ties into the move you've seen in crypto too. I mean, so this is the thing where people are now becoming more genuinely concerned that they need safety. And I wrote a piece 2 months ago asking the question and then answering it, of course, is Bitcoin the new bond, treasury bond, and is gold the new US dollar? And the answer is yes and yes. And now Bitcoin, I have issues with, and I'm not like a Bitcoin fanatic, all right? But I do believe there's value in the sense that if you are in some of these countries where the currency's already gotten smoked, now you're going to go through another round of inflation, all right? That's becoming more accessible in places like Nigeria, where, the currency's gotten smoked, or like Pakistan, and like Turkey. These are places with tens of millions of people in population, or even India, the largest population, where the currency's just gotten annihilated, where all of a sudden now, you don't run down to the local bullion dealer. You can't store a bunch of bars of gold, you're in your house in Africa or whatever, but you have a phone, you can get a digital wallet, you can buy crypto. So when you're talking about general global debt of 324 trillion, all the countries involved, how this could impact currencies, where it's a currency war, where countries are racing each other. I used to call this is what we had in the 90s, all right? When exports started to shrink and countries like Malaysia and Thailand, all the Asian tigers got hit. We saw this coming a mile away. And those currencies got wasted. And one of the themes that I wrote about back then was the currency devaluation raceway, where gold is the lead car normally, and all the currencies were around until they went off the gold standard. The gold car went off the track, and these currencies raced around at the high speed, crashing at the walls occasionally and everything. I think it's kind of the perfect analogy. You're headed back into that dynamic. And that is the case for gold, for silver, for metals, for commodities in general, and even for crypto.
Well, it should be exciting to continue to track this with you. Greg, if our viewers are interested in finding your work, where can they look?
Yeah, you can find me at weldononline.com. That's WELDON online, one word. Or better yet, to email me, and I'll just kind of throw you some samples, maybe put it out for a free trial if you want, especially some of the stuff we did, the stuff I did today. I'm working on a piece for tomorrow that's really interesting in terms of the relationship between India and China and how this relates to all the BRICS currencies, which you absolutely need to keep an eye on these currencies. I mean, it's critical to what's happening. It's like Trump is pushing people away from the dollar. It was happening already. It was inevitable. And I propose kind of like, look, rather than fighting this, which I understand, I mean, dollar losing its status as the petrodollar, as the currency, of means of trade settlement and transactions would be devastating. It would be really an economic blow. But the reality is it's going to happen anyway. Better we be part of it than we left out, because the world's largest debtor nation. I mean, it's just kind of crazy. Well, next to Japan anyway. But the dynamic around that is, look, you're going to go to a system that each trade, if we're trading between, say, Thailand and the Philippines, you're going to use those two currencies, dollar, renminbi, and gold. And it's going to be on the blockchain, it's going to be fractal, and it's going to be based on what the goods are. You have all kinds of ways you can really hone this in to be precise, that is more fair to everybody. Right? Let alone the fact that we're not the biggest trader in the world anymore. China has us on a monthly basis by more than 3-2, both imports and exports. And yet we still want to tell China, you have to use the dollar, we're going to punish you. That's old school, man. That time is gone. We're not the police to the world anymore. And I'm true blue American, red, white, and blue. But at the same time, the realistic approach is this is going to change. That's going to be negative for the dollar, which really exacerbates everything we're talking about in terms of the need to have things other than just passively invested in stocks. Really can't emphasize that enough. I've seen this entire trend. This is the time, 40 years it took us to get here. People say, why is it different? I'll give you 324 trillion reasons why it's different, okay? So email me, Greg Weldon, GREGWELDON at weldononline.com, and I'll send you a copy of the report. I can put you on the list for a free trial if you want. And I am a registered Series 3 CTA. We are accepting new money. It's a very high minimum because I'm a very low risk guy, and these markets are very dangerous. But I think that it behooves people to seek out someone like me that does kind of what I do and has some experience, because that will give you an edge for sure. And this is not a sales tactic. I'm not a pushy sales guy. This is from the heart, and 40 years of doing this. It's coming. You need to be positioned, because like somebody said to me recently, it's not the crash that runs people. It's the lack of preparation. It's the math and the lack of adherence to understanding the math. And the math now is upside down, and it's going to happen. So send me an email. Be happy to have a discussion. But yeah, follow me on Twitter too, at Weldon Live. I'm on YouTube at Gregory_Weldon on YouTube. And then I have my podcast, Money, Markets, and New Age Investing, which can be found on Twitter at Money_podcast.
That sounds good. Thank you so much, Greg. You have a good day, and God bless.
My pleasure. God bless.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 21st through July 28th, 2025, while supplies last. First this week, we have a special on pre-1933 gold. MS62 $20 Liberty coins or MS63 $20 St. Gaudens coins
Are just $90 over melt. Own a piece of American history at just $90 over melt.
Next, backdated 1-ounce platinum eagles are only $270 over spot. And finally, Dealer's Choice 90% constitutional U.S. Mint silver dimes and quarters are just 65 cents over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.